TGIF, everybody. I hope everyone had a decent week. Sinatra, Scott, how are you, Shooter? Shahab, Hugo? Okay. So Bitcoin had that big breakdown under the black line in the sand. Hello, Paul. All right. So yesterday I was talking about that the dollar was a sale up here, short from the 70 level. And this is important because, I can't see the dollar turning. Hello, Jeff Hansen, before we make new lows for the move. I mean, they want these stops. They want these stops. I think we're headed towards 88 and a half or so. And this is important because it's giving a lift to risk. And I think, I was talking about yesterday a rally into month's end, and it's still possible, even though we're going to have a 2 week reversal under 41.75. Well, who knows? We could rally another 35 handles, that we could get a new high in the S&Ps into the end of the month. It's possible. I If that happens, I don't think Nasdaq will. It's possible, but so much weaker that I'm not sure. Uh, gold gold looks good right here, and I think that we're going to be heading much higher. In the gold, short term, it looked like it had a little three drive, but this looks like a flag that we're about to break out of, and there's some upside stuff here. And I do want to address what's happening in the Middle East. Okay, so I think there is a possibility of the war intensifying. The reason is that the Hamas leader did come out and say, thanking Iran for sending them more sophisticated missiles. And it's a first public acknowledgement, even though we've known for decades that Iran has been supplying Hamas with weapons. The first time they came out and said thank you and, admitted it, and it's in your face. And you look at Netanyahu, who's been hanging on to power by his fingernails, who considers Iran an existential threat. I don't think you could rule out something happening between Israel and Iran and Joe Biden being tested early in his presidency. So that's something to keep in mind. That keeps me hesitant from shorting the oil, even though it had a pretty negative day yesterday. Still think that there's a possibility for one more shot up here in oil. And really, the key is going to be the dollar weakening. I think that's about it. Yen looks like it's going to pull back here, so lower yen also will help. And maybe we're even going to get a pullback in yields. Yields did not make new highs for the move. Maybe it's a failing rally. Fed on the stepping on it. So that's my look going in. The dollar is key. Looking for new lows in the dollar, which should be supportive for almost all instruments. A weaker dollar usually is, and that's what makes me think we could get one more new high in the S&Ps, maybe as high as 4,300. We'll see. But I just want to show you guys this. The SQQ, um, I went to the door, was a real nice trade from 1050, 25% or so. And I'll be watching this when the S&Ps are at new highs, if they're at 4,300, especially if we hold the 1040 level in the bearish triple Q ETF. Any questions? Amira, what's no? You don't think there's going to be an escalation between Israel and Iran? No? I hope you're right. Hi, DJ. All right. Blake, We made it another week. We did it.
Yeah, risk has bounced back a lot further than I expected. I actually tried to short the S&P yesterday at 4100 and I got stopped out at 4129 or something. So, it's like okay, well, I knew that we were, coming back up towards resistance and after I got stopped out yesterday, I was just like, man, the stock market's still pretty well bid. I'm surprised, even following the inflation data, that the market's just kind of shrugging it off. And we were talking about that in the chat room just a little bit ago. It's it. Greg, who's been a long time, he's been a long time. When I say long time, I'm talking 6-7 years previous to us even forming Forex Analytics. It's even longer than that, because Greg has I remember when my son got baptized in Greece and I met Steve in Athens. That was about 7 years ago. So it was even prior to that, because he was he helped me actually when I flew into Venice. He's like, yeah, me and my wife did this, and this, and anyway, it's a long story. And we were just talking about we were just talking. So yeah, he's been with us for probably about 8-9 years, maybe. Anyway, we were talking about inflation data and is it really going to matter? Is the market really going to care? And the point I want to try to make here is they don't care. You right now, until the market's going to care when it does, and I wish I knew when that was, but you don't. You know what I mean? It's kind of like, over the years and throughout my career, people rationalize or try to rationalize certain things, and honestly, it just doesn't matter until it does. And then the day that it does, you're like, whoa, wait, this has been happening for this long, and why has it only started to matter to the market now? And it's like the market will grip certain themes when it feels like it. And obviously right now it's not the inflationary theme, because the market looks at inflation and says, yeah, you can run hot because the Fed said so. The Fed said it can run hot. And then you guys could argue, well, it's really hot and it's really going to affect consumer spending. And, I think that the inflation that we're seeing right now is really going to impact the masses and the lower, middle class and lower middle class more than anything. If you take somebody who really is making money paycheck to paycheck, and they have to stretch their money even further because the cost of milk goes higher, or the cost of the goods that you have to buy, gas, clothing, car tires, all those the little things, they end up adding up. And when the consumer has to stop going to McDonald's, or taking on that extra expense that they wanted to, of that thing that they wanted to buy, it's gonna impact them more than it's gonna impact the upper middle class and higher, which doesn't really care so much about inflation. So it's just something that the market doesn't care about it right now, but it will at some point. The one thing I got to point out about the S&P as well, just also keep in mind, guys, even though we've come back to 4,100 or above 4,100, notice we're at a 50% retracement. And also keep in mind, we came out of an ascending wedge. Now, I can really tell you right now, I'm not super excited about this, trying to chase risk up here. Can we make it up to 4160? Sure, we can. Could we challenge the underside of this trend line? Absolutely. Will that take us to near highs? Sure, it could. But I think that this is going to be now more of a bigger issue up at these levels, technically, for the market. Unlike if we would have just had continued higher from 4,100, we would be at new highs and I would have no problem with where we were at. But now that we've made all of these technical levels, and we've reversed at some of these technical we've done some technical damage to the market, slipping below 4,100. I do think this is going to be a bigger issue for the market moving forward. And so that's something that I believe we have to be very cognizant of. This move this week has changed the dynamics of the market. Now, Dale, I heard you say that you think we can hit all-time highs in equities. I'm not so sure. I'm not really
Never really sure.
Yeah,
But now that I see your chart, you make a good case of maybe rallying back to the underside of the wedge line. Where's that come in?
Yeah,
In the next few
anywhere
days?
between 4,170 and 4,200.
Okay.
I think that the technical damage is done, and like I said, I'd have been a lot more comfortable with new highs in the market if we just held 4,100. If we could have held this support through here, it'd be a little bit different story. But
The
you look at
NASDAQ is where the real technical damage has been done.
Yeah, I mean, it's a false breakout. I mean, here let me just
NASDAQ much weaker structure. Russell even weaker.
So here's the S&P. Here's the weekly chart, right?
Yeah.
I mean, it's an ugly candle. Now it's going to end up, I think by the end of the day, it'll end up being a pin bar, because this is not the futures market. This is the cash market. So you'll see this open, when the stock market opens. But if we close lower today, or, lower or worse, then next thing you know, the S&P is going to look kind of ugly. That's an ugly candle when you engulf almost really the last month's worth of gains in 1 week, right? So then you have to worry about like this upper sloping trend line. So again, I'm in the camp that this the break lower this week has done some technical damage that I'm not sure that we're going to be able to escape. Also keeping in mind that this is we're really in a seasonally a really tough time for the market. So we have to be really careful being in May. And again, do I really want to chase risk up here? No, I don't. Am I willing to step back in short right at this moment in time? Not really. Not on a Friday. Especially look at how the dollar is reacting. I mean, Dale, you make a good point. The dollar is really it's under pressure. But if you follow the morning edge, which is the webinar right after we're finished here, the dollar support is at 90.40. We're at 90.40. We actually held 90.42 overnight. We've been looking for this support to hold in the dollar index, and this is really important support that we discussed yesterday. You can see it right here. So I wouldn't be too excited about trying to short dollars right here technically. Now, you could argue, well, it's the inflationary data hasn't even, this week hasn't really even, affected the dollar. But remember, it's still, we still have Friday. We still have today. Today's not over just yet. And so, I mean, it's just some things that and I have to bring up one other chart, in currencies that I think is really important, is I got to bring up the Aussie. The Aussie, really important support. We were talking about this yesterday, if we could actually break through the support level. But I said last night and yesterday in the daily roundup, hey, if we can get back to 77.60, this is going to be a good level to be on the short side. And here we are. But what's interesting about the Aussie and about where we've gotten to, it's taken since yesterday. Let's think about this. Since yesterday, it's taken a rally from, we were at 39 yesterday afternoon. Or yesterday morning, we were at 40.90. And now we're at 41.40. So it's taken a 50 pip S&P rally, a 50 point S&P rally to get the Aussie basically to move from 77.15 to 77.55 to where we're at. That shows you how heavy this Aussie dollar is. I haven't sold the Aussie just yet. I haven't stepped into it, but this is, I was thinking that we would be here yesterday, and we're just now getting here now, which shows you how much recovering the stock market has done, and the Aussie dollar has barely responded. So I guess the point I'm trying to make here is the Aussie's trading really heavy, which is, I would be, if I was long, I'd be really concerned about it. If I was long, I would be like, I don't know if I want to be long the Aussie dollar anymore. When we trade and we trade the markets, one of the things that I love to do as a trader is I love to figure out, what the market would be thinking on the other side. Who on the other side, how are they approaching, the market today? Because again, I'm going to put myself in the shoes of somebody who's long Aussie dollars from yesterday afternoon. I just watched a 50-point rally in the S&P, and my Aussie dollar has paid me 77.25 to 77.55. A 50-point S&P rally has yielded me 30 pips in the Aussie dollar. Whip-de freaking do. What if the S&P drops 20 S&P points this morning? Where's my Aussie going to be? My opinion, I'll be in a negative position. So, think about that. How has the asset moved in its normal correlated fashion to market moves that have transpired recently? And that's how you put yourself in the mindset of somebody who is trading on the other side of you right now. I love to think that way because because I have to say, and again, this is me approaching the Aussie with no position. I think about, if I was long, how would I feel? And if I was short, how would I feel? Obviously if you're short, you're like, okay, well, stocks are grinding higher and the Aussie's finally starting to take hold and we're pushing up to some previous resistance. Hell, if I was short, I would be thinking we need to hold these levels. But if I was long, I'd be thinking, oh my God, it took all of that effort, all of that energy and risk to rally, and the Aussies barely even moved. One last thing I wanted to talk about is I want to talk about the bounce in cryptocurrency. We've seen a bounce in Bitcoin. Let's go over to Bitcoin. Bitcoin has bounced back, and we're back at 50,000. But as I've mentioned to you guys, well, those of you that are Forex Analytics subscribers, and I don't know if we talked about it much here, but you guys know for the last couple of weeks I've been focused on 52,400. That has been the big number for me. 52,400. I'm sorry, 52,400 has been the big number for me for the last couple of weeks. We broke through it this week, and now we can't get back above it. And now if you look at Bitcoin, and everybody's like, oh, it's up like, a couple percent today. Woohoo, Bitcoin's rallying. It is, but technically we're actually hitting lower lows, or lower highs, excuse me. So we're still making lower highs, and that would worry me, right? Ethereum actually, is struggling now. And, the Dogecoin is up because of Elon Musk, but if that subsides, you got to be a little I think you got to be a little cautious with what's happening in the crypto space. I do think that Bitcoin, like the S&P, has technically done some damage. We have formally made a lower low, and you guys know now, especially from yesterday, the Forex Analytics subscribers know that my line in the sand for Bitcoin is now 42,000, or 43,000, the 43,000 to 42,000, this support zone. If that level breaks, that's where long-term institutional people are probably going to be a little concerned. And that's where I think that if Bitcoin starts to break those levels, that's where you start to see a shift in, an attitude over in risk, right? Because the institutional money really was starting in in the 12,000 to 18,000 range. Then they started to really pump their books and pump their positions once we got above the new highs. That would be in the low 20,000s. Then you had the late coming institutional money come in through here. Then you have a lot of profit taking up at these levels. So all their legacy trades now and all their legacy positions are all, hey, as long as we hold above this 40,000 level. You start getting below that, you start getting below the 200-day moving average. Then you start tripping systematic trading systems into being on the short side of not only Bitcoin, but also crypto in general. And then you'll see systematic selling because of that. So then if that happens, how does that influence the rest of the risk assets, such as the S&P or the dollar or commodities? By the way, I was talking to, I was sitting around with a bunch of dads last night at our kids soccer practice. We were just wrapping up tryout season and if you've ever had a teenager who plays competitive sports, the end of season going into the next season is so stressful because if the kids made the team, blah blah blah. And so it's funny, we're a bunch of dads sitting around talking, and our conversation morphed into inflation and used car markets and chips and alcohol sales, because alcohol companies they can't get their bottles in, so they have all this alcohol, but they can't bottle it because of and we're just talking about inflation. It's funny how those conversations morph from, I don't think over the years, I've never had these conversations with dads before. It's interesting. I was just sitting there kind of going, wow, this is interesting that we're all talking about it. All right. So Steve, Stelios, how you guys doing?
Good morning.
Good
Everything
morning.
good?
Good morning,
Good morning.
Phil. Steve.
So how are you guys, what do you guys think of the markets here? We've seen a nice bounce back in risk. The dollar sold off. Is everything good? Are we back to normal? Is this the inflationary data we saw just a scare? Should we care? Should the markets care?
That's a good question. Well, personally, remember what I said yesterday on Facebook?
Gold.
Look, sorry?
Oh, gold cares.
Oh, yeah. What did I say yesterday? I said, look, I don't think anything's changed in the big picture yet. And yes, inflation seems to be rising. The market thinks, and the Fed thinks, it's going to be transitory. There are reasons for that. The inflation we're seeing here is not like we were seeing in the mid 2000s due to huge demand. China was basically building everything they could build, and there was demand-based inflation. This time it's more of a sort of supply issues.
It's supply chain issue, right?
Yes, yeah. And these theoretically are going to be resolved eventually. So there is a rationale to say this is going to be transitory. The problem, I think, is not that it's going to be a couple of months and then we're back to normal. It's going to be drawn out, I think. But I think that's what the market probably thinks. And they just like Steve said yesterday, the Fed, it's going to be very difficult for them to be tightening, especially not tightening a lot, so they're going to try, probably, just like the taper tantrum a few years ago, and they're going to see the market reaction. So the likely result is that they're going to just wait a bit more, which means we're going to have easy money for a long time. And like our friend somebody here wrote, don't fight the Fed. And yeah, when you have this amount of liquidity coming in, it's very difficult to go against it. And its indices are really expensive. I wouldn't say go long here, but it's very, very difficult to go short. You're going to get run over probably. So for me, nothing's changed, unfortunately. I'm still waiting. And I think you're right about the Aussie and the Kiwi. The Kiwi less so, but the Aussie is just not responding as much as it should. So when we do see a turn, I think the Aussie is going to be prime candidate to be shorting.
You want to see and Steve, I'd love to hear your take really quick on not only what we've been talking about, but also I want to mention that Dale, you talked a little bit about the Middle East, and this is something that I know not the market's not really talking about it right now, but maybe it should be. But anyway, hey, I wanted to point out with the Aussie, like look at the pound Aussie, okay, and the pound's been a very strong performing currency as of late. But if you're really bearish the Aussie, look at the pound Aussie and look at how we're at really key support, building a nice triangle. This is, I can just tell you guys ahead of time, this is really one of my, charts that will end up being a chart of the day if we break out, because it is really poised to break higher. And same with the Euro Aussie. You look at the Euro Aussie, this is the chart of the day yesterday. Look, we get above 157, and I would not want to be short this. We're already breaking out of the triangle. I mean, this will point to 156, or 159, in my opinion. Then the 200-day moving average after that. So you want to talk about how weak the Aussie is. Look at how weak it is against other currencies, and I think that's worth noting. But Steve, what are your thoughts here with the inflation and how it's affecting the market?
Yeah, I think that everybody knows, since I'm very vocal, all my thoughts that have to do with inflation. Now, how it is affecting the market. It would be easy for me to say that the market is surprised and kind of scared that inflation is going to derail the monetary madness that has led to the non-stop rallies. But I don't want to speculate about it and take the other side of what I consider to be the trend. Meaning, I do consider that it is possible, and from a risk-reward perspective, yesterday's rebound might be offering a very nice opportunity against the highs to try to seek more weakness temporarily in indices and more strength in the dollar. But other than short-term trades, nothing has changed having to do with my overall thesis. And I do believe that sooner or later, the general theme, lower dollar, higher stock markets, is going to resume.
Okay,
so it remains to be seen, how long the effect of the inflation scare, that higher yields are coming, so on and so forth, is going to last. Might last a few days, might last a few weeks, might be a good opportunity for markets to, to alleviate the extreme bullish conditions. We'll find out. I do think, though, that, something is going to happen. We're going to have Fed governors coming out again, Yellen, or whoever else is needed. And if we see some risk of, extending, we're going to get the type of statements that the market needs to keep on rallying and keep on selling the dollar.
All right. Well, let's talk about what's happening in Israel. Dale, I know you're staying up on the news. Is this something that we should really be concerned with, and the market should be paying attention to?
Yeah, well, if you have followed Netanyahu over the years, he made all kinds of speeches to the UN and considers Iran an existential threat.
Yep.
He's very long in the tooth in his career. And I really think that Iran just gave him the public relations reason to possibly start something, when everyone knew for decades that they were supplying Hamas and Hezbollah with weapons. But you know what? The leaders of those two groups never came out and thanked Iran for sending more sophisticated weapons. It's almost like it gives them a justification to pressure Iran. So yeah, I'm a little concerned that it could turn into something bigger than just Israeli-Palestinian Gaza situation, which has happened several times. It seems a little different this time.
All right. Yeah. I mean, okay. Then you know, and Steve Stellers, do you have any views about that before we turn it over to Dale for his,
You know what, guys,
adjustment
we
of
could
the-
keep going. Peter Goldstein sent me a message on Twitter this morning at the last minute that he has COVID, and he doesn't. He thought he'd be better by today, but he doesn't feel well. I
Oh,
tried to scramble for a replacement. I couldn't find one
Oh, no
with
problem.
like a
Happens.
half an hour.
It
well,
happens.
that, you
Oh,
know,
retail sales numbers actually. Hold on.
yep.
What did
Thank
we
you.
get? We got worse. Oh, worse than expected.
Retail sales at 0.
Both retail sales and core retail sales. Yeah,
Does that mean no one shopped?
but that's better.
No,
better.
I'll tell you what it means. Just look at last month's revisions, Stelio, and you'll
Yeah,
understand what
revisions are a
happened.
lot higher. Yeah.
Revisions of last month are like tenfold
True.
higher. So what
Yeah.
happened? People got the money, they spent them all, and now they're waiting for the next handout before they can do something.
You know,
And
it's
Mustafa,
interesting.
I agree with you.
And
It's both
and by the
sides.
way, that you know, you bring up an interesting point, and then we'll get to the charts. Actually, what I'd like to do is I'd actually like Steve. I'd like you to look at some of the charts and really point out a few things. Cable's ripping here, but and so actually the dollar's just getting hit right now.
Yeah, it wants
but
that new low, Blake.
I'm sorry.
I think we want that new low under 89.20. Clean out all the remaining dollar bulls.
We're
the daily.
we're at support right now. We'll see what happens, but I want to mention this really quick, and then Steve, I'll let you be able to show some charts here.
No,
here.
my comment had to do with what we were saying now before the charts, and it is, I think, Blake, and I don't know if you agree, that following the inflation data, we've now specifically entered a period that the market is in huge need of bad news. I know it sounds counterintuitive and stupid, but of course, when you live in stupid markets, you have to think stupid. But bad data now are going to alleviate the jitters that perhaps the Fed is going to act preemptively for inflation. You know what I mean?
I 100% agree with that. Actually, the bad data is good. We are in
Yes.
that. Bad
Yes.
data is good data is bad. You know, that
And
is
of course,
definitely
the market
dynamic
ignores
within.
the elephant in the room, which is bad data and higher inflation has nothing positive to it. It is what we lived in the 70s and the 80s, and it's called stagflation.
Yep.
And stagflation has no positive spin to it, none
Yeah.
whatsoever.
Yeah, higher inflation with slow growth or low growth or no growth, that's not a good mix. And that's something that I think is at risk. You know, it's I'm going to leave you guys with this, and then Steve, I'm going to let you take over. You know, in that conversation with those guys that we were just talking, I was talking with the group of dads. One of the dads, he owns 3 restaurants here in town, very popular restaurants actually in like the hipper part of town, whatever. And he was just talking about how he can't get workers. They had to remodel. They spent this COVID year like remodeling one of their main locations, and then he was telling me this situation I thought was so interesting. Like, people are ordering like this economic relief, they're filing for it, and you get from the government like these prepaid, I guess, cards. That I didn't know that this is how it worked. You got these prepaid cards, and then you can take these prepaid cards. They give you your stimulus money, whatever it is, $2,000-$3,000, whatever it is. They give you these prepaid cards, and then people are filing them for deceased people, right? So the guy, the dad that I'm telling you, he walked to his mailbox for his company, his business mailbox, and he's like, yeah, I got all these, Center of Economic Relief, blah blah blah, and he's like, I thought I had to file paperwork for these people. It's all these random names. I have to file paperwork for these people. And then, I thought maybe they're people I work for that work for me. I have no idea, because he has so many employees. And I guess what it is somebody's applying for these prepaid cards, having them all sent to his, mailbox, which is basically an outdoor mailbox. And what they do is they come by because they know when the mail drop's going to be. If he would have left him in there probably another few hours, somebody would have came in and bashed in the mailbox to take all of these prepaid credit cards and to go spend the money. And I was sitting there thinking, okay, he's like, yeah, I had like 8 prepaid credit cards. I, sent them all back, but he's like, that's kind of crazy, right? And I'm like, what's more crazy is there's somebody out there who just like literally put yourself on the line doing illegal stuff.
Somebody? What do you mean?
Make
I bet there is a whole industry.
$12,000. It's like, and it's, semi brilliant, I guess. If you could just use that effort to do good in the world, it's like, why? What the hell is?
Yeah,
wrong
but
with
people
people?
don't think like that, Blake. And
I know it's
if you
it's so
remember, I
crazy.
mentioned and I explained in advance that all these handouts are going to bring a lot of fraud. I remember specifically saying on the webinar that we had a record opening of new companies post the first COVID relief packages. Why? Not because economic activity had picked up, because there were a lot of people that were foreseeing that that was not the first and only relief package. So they wanted to have companies to claim benefits when the second one came. The amount, there is an economic truism. I've said it 100 times, you always get more of what you substitute and less of what you tax. So when you give handouts to specific groups of people, people will go out of their way, make anything possible to be able to pick up those handouts. That's why always when a government does some form of handouts and they make some kind of calculation of what it's going to cost them, it always costs them more than they what they believe initially, because they might have a specific group of people that think will claim the benefits, but people will do whatever possible to belong into that category. And the opposite has to do with taxes. Whenever a government...
Steve, yeah. let's provide the viewers that are here some value in like showing them some charts and some setups and stuff. We could go down this road for hours, and let's not. But I wanted to just kind of tell you this, that I think it's crazy how a lot of people
a lot of fraud. Yeah,
there's a lot of fraud out there.
A lot.
And let's also just I'm going to leave you with this one last thought. I think people want to, find jobs right now. I think they do, but work gets in the way.
That's funny.
The problem.
All right,
problem.
Steve, I'm gonna let you take over the charts. Why don't you show some folks here what some
the problem with
some...
your friend and what you said is that for workers now he has to compete with the government that pays people not to work. That's the main problem. So what I'm looking in the short term, because the longer term we've discussed multiple times, I think there is a technical argument to be made that we can see at least one more leg lower in equities from here, right? So this is what I'm looking for. So I do think that this move lower is most likely corrective, but I do also think that there is a good likelihood that there is more to it before it actually exhausts itself. And as I said, we get statements and all the rest, and then everybody goes back to, everything is fine. I can keep buying stocks and they have my back, and they're going to take care of me, and I'm going to do all right. So we're already seeing a very short-term reaction from the 50% fib, but I wouldn't be surprised if we extend a little bit more to meet the 61.8 and the underside of this broken channel before we see lower levels. Now, is this a guarantee? Of course not. Nothing in trading is a guarantee, but I do think it's a good risk-reward proposal. Now, clearly, if that's how the price action in equities is going to unfold, then that more or less means that the price action in the dollar will unfold more or less in an opposite way, something like that. So another leg lower in equities would inevitably mean another leg higher in the DXY. Of course, I don't want to repeat myself by saying that, yes, risk off does bring dollar bidding. Is it really something to show for? Not really. I mean, the dollar clearly has been for a long time now in a period that rebounds are generally tepid and contained, while the moves to the downside are a lot more impulsive. So I'm not saying that I would be looking like for much higher levels in the dollar, but definitely if we get a little bit more risk off, we should see the dollar get a little bit of a bid. Now, I wrote it yesterday in the chat room that I sold some S&P, looking for this type of short-term trade. Nothing to do with my long-term thesis, of course. This is purely short-term trade. I don't expect to hold it one way or another, works or doesn't work, more than, I guess, by the middle of next week. Most likely it's going to be gone, either with a profit or with a small loss. Depends on what happens here. Now, the bigger picture in the S&P is clearly that we have this trend line support. We need to break through it in order for us to start making arguments that we might have in hand a much deeper corrective move in indices. Until that happens, I would be very conservative in downside targets, because don't forget that trend is your friend, and the medium term, and needless to say the long term, of course, as well, trends have not been broken in any way. So I would advise people in being very, very cautious when they want to trade counter trend, obviously. Now, having to do with gold and silver, during the past few days I've been focusing more on gold. And why is that? Because simply put, gold is trading very, very, very close to a key confluence of resistances between 1850 and 1855. I consider this to be a major pivot area for the metal. I think we break through that. We finally break through this corrective. I was saying since the beginning that this type of price action is definitely corrective in nature, but of course, you can never be sure when the correction is over. I do think, though, that we break through 1855 and the chances that the correction is over and we've resumed the upside increase substantially, in which case I would be expecting this move to extend and produce new all-time highs. Of course, gold does well, inevitably silver is going to do well. And usually when precious metals are doing well, silver is doing even better than gold is doing. Of course, there is still the scenario for both of them that we can see this complex correction unfolding more. How is that going to happen? It's going to happen if the prevailing thesis for the next few days or weeks becomes something like, oh, higher inflation means hiking of rates. Hiking of rates means negative for precious metals, so we should be selling it. I've explained multiple times why I think this is the wrong thesis, but that doesn't mean that the market cannot follow it for a period of time. Platinum consolidating, palladium correcting its prior losses, copper slightly pulling back from all-time highs. Keep that in mind. Copper is also one of the commodities that is at all-time highs, so keep that in mind. I think any pullback towards like 436 is going to be a buying opportunity. Now, I'm not advocating that somebody should be buying, at all-time highs, but I don't think you should be fading strength either. Now, having to do with cryptos, I'm in par with what you've said, Blake. I do think that there is some kind of a deeper correction coming here, especially for Bitcoin, which seems to be underperforming lately the rest of the crypto world, and we've also seen that by the loss of market capitalization in comparison to the whole market. In the case of Bitcoin, it has gone down from like 70% of the total crypto capitalization down to roughly 45%, I think now, which is a rather big shift from like what's considered like the crypto blue chip to like smaller, you know, cryptos, smaller capitalization cryptos, like, you know, obviously Dogecoin has been the one that has benefited the most. Now, having to do with effects, this is what I'm monitoring here in the euro. I mean, we seem to have broken out, so it seems to be performing a little bit better than, you know, the dollar index in the inverse, of course. The cable remains, as you said before, you know, very, very, very well bid. So I think there is no doubt about it. And now, what comes down to me being torn is commodity currencies, because I can see both sides of the argument here. I can see why we might have another leg lower before we resume the uptrend in both the Aussie and the Kiwi. Of course, in order for that to play out, we definitely are in need of risk off. So we need to have that move that I was talking about play out. I have no doubt that we're going to see higher levels rather soon. The question is, are we about to see a lower low to complete this, you know, a three-wave corrective move lower before higher, or are we going to move straight higher from here? Risk assets are going to provide the answer to that. And of course, if we have a look at other currencies like the Canadian, like the NOK, you know, it's more or less the same thing. I have to honestly say that lately the Canadian dollar has been one of the strongest of the commodity currencies. Look at how we broke down from this channel. We tested the multi-year lows. We actually intraday a couple of days ago on Wednesday traded below the multi-year lows, but now we seem to have found resistance again on the retest of this broken trend line support. And in the case of the NOK, this is what I think might be in play here. We broke down from this triangle. We came back, we retested it twice. We failed in both occasions. So, you know, we break down from this trend line support and it's lower lows once again, right? So, you know, that's why I don't like to fade trends, because, you know, we had a nice rebound in the dollar. But as you see, there are many currencies that haven't made the dent, having to do with their recent trends, right? So as I said, the only thing that can provide a little bit more life to the dollar is a continuation of this risk-off move that started, which, you know, it's a 50-50 if it's going to happen. Nevertheless, we currently have an appealing risk-reward ratio for something like that to unfold. So I think within the next few days, we're going to have a very good idea of, you know, what's happening. Let me take a couple of questions.
They're not used to asking your questions anymore. Mira's asking for, of course, platinum and palladium, but I think you already gave it to him.
Yeah, somebody's also asking about euros, so we can have a look at both euros and euro kiwi. Now, let me give you my thesis, and I need to, you know, I always like to do a top-down analysis.
Someone's asking what kind of handout you and Stelios got from the IMF during your crisis. All right.
I've made the argument before, and I know that people, I know that people that don't follow economics very closely will totally disagree with me. But if you're asking me which is a more healthy economy at the moment after the recent crisis, the Greek economy or the US economy, I have no trouble answering that it's the Greek economy.
Yeah.
We entered the COVID crisis with an actual budget current account surplus, and for years, right? Because all the big part of the structural problems in a very harsh way, but they had to be solved following the crisis. Now, let's not look at the US budget, right? Other than the fact that, for example, the US has a current deficit that is way north of 10%, counting, of course, the off-budget items that should be counted, and you can only see them in the amount that you need to borrow to make it through the year. The US currently has something like $160 trillion of unfunded liabilities for the next 10 years. How much does the US collect in taxes on a yearly basis? Around 4 to 4.5 trillion. Now, if somebody can mathematically give me the answer how an economy can be solvent running more than 10% annual deficit and having something like a $16 trillion unfunded liabilities per year for the next 10 years with a government revenue of around 4 trillion, I will be more than happy to have this conversation. Now, the Eurozone. I think that this parabolic move higher might have been, it's a big word to say like an all-time high or something like that, but might have even been a generational high. So impulsive move lower, correction, another move lower. I see another correction here. So direction in the medium to long term, I think it's lower, clearly lower. Now, within that context, is it impossible to see another leg higher before we go lower? No, it's not, right? So either of the two, in my opinion, is going to happen. But the general direction remains lower. And Euro Kiwi, same deal. You can see it here. I do think that this move is corrective. There is room for more upside. So for something like that. So in the short term, we might get an extension higher, but I think it's going to be just short term.
I think
that's what I think.
Greg is trying to reach you on Skype. I don't know what for, but
Reach me on Skype. Let me see. Sorry, I don't look at Skype when we're in the.
Yeah, I know.
There. Sorry, Greg, I really don't understand what you. I don't understand what he means exactly, to be honest. I just asked him. Pound Kiwi. Somebody's talking about a head and shoulders formation in the pound Kiwi.
He wants to know if you could join the webinar later, Steve. Maybe Morning Edge is what he's asking about.
Yeah, absolutely. Okay, so Forex Analytics members, you're going to have Gregor with us in the Morning Edge. So, I don't know about a head and shoulders formation. Doesn't look really pretty. But I can tell you that, look at this. It's the same deal. Long-term channel, corrective or impulsive? Corrective. We've been breaking down, and now we have, in my opinion, another corrective rebound. So we might rebound a little bit further, but I think lower as well. And guess what? Pound Aussie, exactly the same deal. You can see it's not by accident these formations look so similar to each other, right? There you go. That's what I think about all these crosses. Scott, this is a very, very nice interpretation, but give me an answer mathematically. You say Greece is 177% of GDP debt versus the US, which is 101. First of all, neither of the numbers you're giving are correct. Both the Greek debt and the US debt is higher than that. But other than that, why don't we talk about trajectory? Because I can show you how the US debt will have surpassed the Greek debt within 5 years. So don't look only at the absolute numbers, look at the trajectory of the numbers. So yeah, no disagreement there. The Greek debt is for the time being higher, but the trajectory is completely different. Pre-COVID, the US was running surpluses, while the US was running an every year increasing deficit. And from what I see from politicians of both parties, I mean, there is zero intention to address it for the time being, zero. So I don't even see the will to do something about it. So when you have an exploding deficit and there is not even a basic will to do something about it, all the discussions are surrounded about how much money should be spent on infrastructure and so on and so forth. I'm telling you, not even 5 years until the US debt surpasses the Greek debt. I bet you in front of everybody that's listening at the moment, if you want to take the bet. So what's the answer for the US? Higher taxes? Absolutely not. Higher taxes are going to collect nothing. The answer is what the answer has always been: less government spending. The answer is never higher taxes. The answer is always less government spending. Steve, current administration is trying to tax rich and companies. I'm going to tell you, good luck. Governments always find that capital is mobile, and whenever you try to tax something, you find a lot less of it to collect. So good luck. If you believe you can collect the money you want to be spending from taxing the rich and corporations, good luck. It has never succeeded in the past in any country. If you believe you're going to be the first ones that do it, good luck. The answer is always one and only one that works: less government spending. Let the free markets produce stuff. The government doesn't have to be involved with everything, and excess taxes lead to less collection of taxes and fleeing of capital, nothing else.
If you only had conviction in what you believed. If you only just had a little bit more conviction, Steve.
Oh yeah, absolutely. Yeah.
Yeah.
Infrastructure spending is something that it's the only type of spending, Ziggy, that can long-term lead to better economic performance. The thing is that you also need to have some money to do it, right? And don't forget that under normal circumstances, infrastructure spending is not a benefit to the economy in the short to medium term. It's a hindrance to the economy. So keep that in mind, because infrastructure spending takes time to develop. So you devote some factors of production today that can yield results years later. So keep that in mind, right? So in essence, you take some factors of production that could be used elsewhere today, so you can gain something in the future. I'm not against infrastructure spending per se, but in general, when you have such high government spending, in my opinion, there needs to be some kind of understanding that spending has to come with cuts in other areas. You know what I mean? The general idea that all spending can come through printing money or raising taxes, which don't yield so many results, as I've said, actually they have negative results. After a point, is futile. I agree. I agree, Ziggy. I'm totally in agreement with you there. Okay, so I think that's it for the week. Of course, we're going to have the morning edge starting in 17 minutes. Greg is going to be with us. So Forex Analytics members, don't miss it. We'll be there in 15 minutes. Have a wonderful weekend, the rest of you. Bye-bye.